All right. Hello, everyone. My name is Corey Daharsh. I'm here with Advanta IRA to bring to you guys another great educational webinar. Our topic for today is how to invest into debt funds with a self-directed IRA account. And I've got a great guest speaker here to help me today. Again, I'm Corey Daharsh. I've been with Advanta IRA almost 10 years now. I've worked a number of different roles with the company, starting in the account management and operations team, assisting with accounting department stuff. And for the past 5 years or so, I've been on the business development team. So networking, educating investors on how to use these self-directed accounts across a number of different investment strategies. So if you have any interest in learning more or need any assistance with what you can and cannot do with a self-direct account, all my contact information is here on the screen. Please feel free to reach out. I'll be very happy to assist you. Also, my guest today is Andrew Montoya from the Mid-Atlantic Group. Andrew is currently the Director of Strategic Partnerships. I've worked with him for a number of years and actually had his partner, Nathan Larson, on the podcast or webinar rather a few times in the past. So I'm really happy to have Andrew on and actually be my guest speaker today. Usually he's helping in the background with stuff. Andrew, thank you very much for joining me. And anything on your background or your expertise you want to talk about with the audience before your portion later on in the presentation?
No, just thank you for your time, Corey. Very excited. Like you said, it's kind of the first go around being front and center. So happy to give my perspective today. So looking forward to it.
Awesome. And for the audience, I'm just going to cover a brief explanation about self-directed accounts, and then I'm going to turn it over to Andrew for covering the debt fund investment side of things. So just a brief background, Advanta IRA as a self-directed retirement administrator has been around for over 20 years. We pair each client of ours with a dedicated client account manager. So you have a one-to-one point of contact. You don't have a call center and have to explain who you are and what you're doing every time you want to do something new with your account. All of your funds that are not actively invested are secure at FDIC insured institutions. And we basically have a really large client base, both in number of clients and total number of money under our administration, just over $3.5 billion as of right now of dollars that clients use us to invest into alternative investments. So what is a self-directed retirement account? Maybe you're familiar, maybe you're just hearing about it for the first time. It's basically a retirement account that's always existed, where you don't have a fiduciary or a financial advisor telling you what and where you can invest the money. So we are experts in the IRS's rules and regulations, and we apply those rules and regulations and assist our clients with them so that you, the account holder, can make investments into various alternative investments that those fiduciaries will not let you invest into. They typically only let you invest in stocks, bonds, mutual funds, publicly traded assets, whereas the retirement account itself is eligible to hold a multitude of different assets. Debt funds like we're here to talk about today, physical real estate, cryptocurrency, precious metals, private lending. There's a number of different things you can do with these accounts. Just a lot of people don't know that they can because they haven't heard about it, or they're with a fiduciary that may tend to lean in the favor of telling them it's too risky, too scary, too volatile. My opinion, it's your money, and if you have an expertise or an interest in any type of investment strategy, you should be guided in the right way to do that with your own decision-making power and your own retirement dollars. So if you haven't heard about a self-directed account, I just kind of told you some of the reasons you might not have heard about it. It's very common, actually, so don't feel like you're missing out on anything. Only about 4% of US-based retirement accounts are self-directed right now, and that's an industry that has about $40 trillion in it. So right about the same size as the national debt is how much money that US people have in their retirement accounts. And only about 1.5 trillion or 4% of that is being actively self-directed. And that's simply because people don't know that they can even do so. So you're taking a big step here today, just learning a little bit more about some of your options and that this even exists for you. So why do people choose to self-direct? Well, it's a new source of capital. You find out that you can do these types of investments with your retirement funds. Maybe you're already investing into debt funds. Maybe you're already a real estate investor or investing into cryptocurrency and didn't know that you could do that with your retirement dollars. So a new source of capital. People are getting fatigued with the stock market after the past 4 or 5 years, if not a little bit more. Just the roller coaster ride that's going on in the stock market. People, if they aren't switching their full account, taking off some money and diversifying into alternatives just to hedge some of that liability. And then finally, the tax benefit of investing with your retirement account. You're generating either tax deferred or tax-free income with these types of investments. Now, there's some give and take on that. You can't take advantage of like depreciation and things like that if you were making these same investments personally, but you can take advantage of the tax deferred or completely tax-free status of the earnings that you generate. And speaking about that, I'll just talk real quick what type of plans we offer. So most people are familiar with your traditional and Roth IRAs and inherited IRAs if someone's passed away and left you as their beneficiary. But we also offer SEP and simple IRAs and solo 401ks if you're a small business owner or self-employed. And we also offer health savings accounts and education savings accounts if you are someone with a high deductible health policy or have a child in your life that you'd like to set aside funds for qualified educational expenses, invest that money, and let that grow within a self-direct account. Now, funding these accounts is the last major thing I really want to talk about because there's a lot of misnomers on funding these accounts. I hear all the time in my first conversations with people, oh, I think it's going to take too long, or it's going to trigger a tax event, or this or that. They're all misnomers. So I want to break it down for you very simply. When you set up a self-direct account, there's 3 key ways to fund it. Via a transfer from an existing retirement account of the same type. So let's say you have a traditional IRA and you want to set up a self-directed traditional IRA. It's a non-taxable, non-reportable event. You fill out a transfer form for the company you want to receive the money. They send it to the company currently holding the money. It's usually wired or a check is sent within about a week to a week and a half, roughly. The second way to fund these accounts is by rollover. And a rollover occurs when you have funds in one type of plan, typically an employer-sponsored plan. So that old 401k you forgot about, a thrift savings plan if you're a military employee, 401k, 403b, 457, any of those employer-sponsored plans. Once you leave a job, that money is going to stay in that plan unless you tell them you want to move it somewhere else. And sometimes they don't even let you benefit and earn in that plan once you terminate that employment. So getting a hold of that money and putting it to your own use is of great importance to a lot of people. And you do that by initiating a distribution for rollover out of that plan and rolling it over into a new plan. This does create some taxable reporting, but never a taxable event. So you're looking at the company sending the money out, telling the IRS, hey, this person took this money out of their retirement account, and the company receiving the money telling the IRS, hey, they moved it right into a retirement account over here. So there's no taxable event. It's a wash from that standpoint. In this case, with rollovers, they typically take about 2 weeks or so because 99% of the time, they will only send funds via rollover as a check. And once we receive that check, it's subject to a standard deposit hold. So you're looking at about 2 weeks or so, give or take, before that money is actively in your account, ready to push to whatever investment you'd like to make. And then the final way that people fund these accounts is with an annual contribution. The IRS has limits on a contribution amount based on your earned income every year. On average, those limits go up slightly year after year. There was a moratorium in them raising during the COVID pandemic, but in general, whatever account type fits your needs best, there's going to be an annual limit for how much you can contribute into that account each year. And that's kind of the final piece of funding these types of accounts. Again, all of these are non-taxable, non-reportable possible events, and you can get these accounts funded pretty easily and within a reasonable time frame. I do want to express that contributions are different than your earnings. So if you set up an account and it makes an investment and then you start making earnings on it, that does not count against that contribution limit I just mentioned a moment ago. That is completely separate. That's passive income you're generating from your account. A lot of people think, oh, I made this investment for $50,000 and it generated $4,000. I can contribute $4,000 less than I thought I was going to. That's not the case. It's a completely separate category and capacity. So the rules and regulations are very simple. You cannot invest into anything that's subjective in value. So life insurance or artwork, fine wine, things like that. You cannot invest with people that are considered disqualified persons. So your parents, your children, your grandchildren, anyone on a lineal family tree with you. And you may be making investments that utilize more active income than passive income. And in that case, you may be subject to UBIT or unrelated business income tax. Or if you're making investments that are leveraged, utilizing financing, there's UDFI that may apply. I'm not going to jump into any of those because they're not the topic of the day. If you wanted more information, you could reach out to me directly. But I just wanted to break down some of those rules real quick, and also just very briefly explain to you again that chart of disqualified persons. What this chart means is you can't transact with these individuals. You can partner with them, but you can't be on the other side of a deal or a transaction from a disqualified person. Again, if you want more information about the rules and regulations, you can reach out to me directly. Just a quick disclaimer. This goes for myself. I'm sure Andrew will have his own disclaimer he'll provide you guys. We're here for educational content. This is not an endorsement of any specific product, opportunity, investment. It's up to you as a self-directed investor to do your own due diligence, consult with your own CPAs, attorneys, tax preparers. This content you're watching today is strictly for educational purposes. So that's my disclaimer. That's as much as I'm going to explain to you guys. At this point, I'm going to turn it over to our expert for the day, Andrew Montoya, who's going to cover how to invest into debt funds. Andrew, the floor is yours.
Oh, perfect. Thank you, Corey. And thank you, everybody, for joining us today. I'm really excited to spend some time with you discussing private lending, private credit, and how investors are using self-directed IRAs to access alternative investments that are focused on consistency, collateral protection, and predictable income. For those of you who may not know me, my name is Andrew Montoya. I'm the Director of Strategic Partnerships with the Mid-Atlantic Secured Income Fund. And so today's presentation is designed to be educational first. Our goal is not to give you a sales pitch. Our goal is to help you better understand how private lending works, why private credit has grown substantially over the last decade, how investors are using these strategies inside self-directed IRAs, and also what investors should evaluate when considering lending opportunities. One thing I'd encourage everybody to keep in mind throughout today's discussion is this. In retirement investing, consistency and risk management often become far more important than simply chasing the highest possible return. And that's really the lens we're going to approach the presentation through today. And so today we're just going to be taking a deeper look inside the world of private lending and private credit. Over the last several years, investors have increasingly searched for investments that are, less correlated to public markets, maybe more focused on income generation and backed by tangible assets. And so private credit has become one of the fastest growing sectors in alternative investing for exactly those reasons. And so what we want to do today is really simplify what can sometimes feel like a very complicated industry. So we're going to be breaking down, how private lending works, how risk is managed, how investment pooling works, and also just, why investors are incorporating these types of strategies into their retirement planning. And so throughout the presentation, I do want everybody to feel comfortable submitting questions. Some of the best conversations usually happen during the Q&A portion at the end. But with that foundation in place, we can begin talking about the broader environment that investors are navigating today. Thanks for jumping into the first slide, Corey. I appreciate that. But the world investors are navigating today, does look very different than it did even 5 or 10 years ago. We've experienced inflation. We've seen a little bit of market volatility, rising interest rates. And, we've also seen, geopolitical uncertainty, as well as major swings in both equities and fixed income markets. And for many investors, I would say, especially investors approaching retirement or maybe already in retirement, the biggest question usually becomes, well, how do I preserve capital while still generating meaningful income? Because historically, many investors have relied heavily on CDs, bonds, money markets, traditional stock portfolios. And so, today many investors are looking for additional diversification, but maybe outside of traditional Wall Street products. And so that's one of the reasons that private credit and private lending have continued gaining attention. And so private lending really focuses on contractual income, collateral-backed lending. It's built around structured repayment terms. And for many investors, that creates a level of predictability and structure that can complement a broader retirement portfolio. And so one phrase I would want everybody to remember throughout today's webinar is this, predictability matters. especially when investors are thinking about income generation and capital preservation, right? And so with that broader context kind of established now, let's talk about what we're actually going to cover today in the presentation. So Corey, could you jump to the next slide? Awesome. Thank you. So today's webinar is really designed to build layer by layer. So by the end of today's presentation, you should walk away with a much stronger understanding of how note lending works, how private lending differs from traditional banking, how risk management works within private credit, why diversification through investment pooling matters, and also why many investors, prefer working through an asset manager or a debt fund instead of trying to lend independently. And so we're also going to be discussing some of the operational and tax complexities that many investors don't initially think about when they first explore self-directed lending. Because one of the biggest differences we found between successful long-term private lending strategies and problematic ones usually ends up being the structure, the process in place, or the approach to risk management. And so that's really where experience and discipline matter. And so before we get into the mechanics of lending itself, let me just give everybody a brief overview of who Mid-Atlantic is. So we can get into the next slide, Corey. Thank you so much. And so at Mid-Atlantic Secured Income Fund, we are a private debt fund specializing primarily in real estate secured lending. And so we raise capital from individual investors, financial institutions, and corporate entities. And then we deploy that capital into short-term, first position real estate secured loans. So a major portion of our lending activity is going to focus on new construction, renovation, redevelopment, and also a smaller part of the portfolio is transitional real estate opportunities. And so one important distinction to understand is that our investors are debt holders. So this is very equity structure where investors participate as equity holders, hoping for upside participation. So instead, our model is designed around contractual income and interest distributions. The business has been operating since 2010. We're headquartered in Atlanta, Georgia. And over the years, the company has participated now in financing more than 700 plus properties across Georgia and the broader Mid-Atlantic region. Another important point is that our focus has always been conservative underwriting and collateral protection. So we're not trying to speculate on massive upside. What we're trying to create is consistency, discipline, and stable income generation. So that philosophy really influences every aspect of how we approach lending. And so, really briefly, let me just introduce the leadership team behind the company. And so one of the things, I believe investors should always evaluate when looking at any alternative investment opportunity is the experience and stability of the management team. And so at Mid-Atlantic, our leadership team is going to bring experience across lending, finance, operations, underwriting, investor relations, and also real estate. Nathan Larson, our Chief Investment Officer, he's been instrumental in building the company's lending and risk management philosophy over the years. Bryce Hall, he's our Director of Finance. He oversees finance and accounting. Michelle Abernathy, she leads operations and servicing. And my role focuses heavily on investor education, partnerships, and strategic growth initiatives. One thing I think is especially important in private lending is just operational alignment. So private credit is not simply about finding loans, right? It requires underwriting, servicing, compliance, asset management, and just ongoing monitoring. And the operational side of lending is often what separates disciplined managers from managers who run into problems over time. And so now that everybody has a little bit of context around who we are, let's just start with the fundamentals of private lending itself. Thank you, Corey. And so I love this quote because it really simplifies lending down to its core. So lending is the process of transferring idle money into the hands of the industrious and innovative for a share of their profit. And so at its core, lending is simply capital allocation, right? So capital is sitting idle and then it's deployed into businesses, projects, entrepreneurs, or operators who can use that capital productively. And in exchange for providing that capital, lenders then earn interest. And so that's fundamentally how banking has always worked. And what private lending does is it allows investors to participate more directly in that process. So one of the easiest ways to think about our business model is this. Quite simply, we are the bank. So instead of deposits coming into a traditional bank branch, investors allocate capital into the fund. That capital is then deployed into carefully underwritten lending opportunities. Payments are then collected, interest income is generated, and then distributions are paid back to our investors. So what makes private lending especially attractive to many investors today is that it can provide contractual income, shorter duration structures, collateral protection, and then reduce correlation to public markets. So this naturally leads into the question, right? Why has private lending grown so dramatically over the last decade? And that really starts with the changes that we've seen in traditional banking systems. And so we can go to the next slide, Corey. And so one of the biggest shifts we've seen in the financial markets over the last 15 years came after the Dodd-Frank Act of 2010. So following the financial crisis, banks faced significant increased regulation. And while many of those regulations were necessary, they did also create substantial limitations around loan concentration, underwriting guidelines, the types of lending that banks were willing or able to pursue at the time. And as a result, large portions of the market became underserved, especially smaller balance lending, niche lending, transitional real estate, or just relationship-based financing in general. And so that created a major opportunity for private lenders because private lenders can often move faster, more flexibly, more relationship-oriented than traditional institutions. Now, that does not mean reckless lending, right? In fact, one of the biggest misconceptions about private lending is that higher rates automatically mean higher risk. But in many cases, the higher rates actually exist because borrowers are paying for speed, certainty, flexibility, and specialized execution. And so, it's not necessarily because the loan itself is inherently riskier. And that distinction is really extremely important. And so I just want to take that concept one step further and discuss how private lending differs operationally from traditional banking. And so go to the next slide, Corey. Thank you. So when investors first learn about private lending, many initially think, why don't I just lend directly myself? And while direct lending is possible, there are many operational realities that investors don't initially consider. So one of the advantages of working through an asset manager or a debt fund structure is simplification and diversification. So an experienced manager handles sourcing opportunities, underwriting, legal documentation, servicing, collateral monitoring, portfolio management. So that dramatically simplifies what could otherwise become a very complicated business, especially inside of a self-directed IRA. Another major advantage is diversification. So instead of one investor being tied to one project or one borrower, capital is diversified across a portfolio of receivables. So that's going to help smooth out timing fluctuations. It's going to reduce single project concentration risk. And ultimately, for many investors, the goal is not to become a full-time lender anyways, right? The goal is to create passive income, predictable cash flow, and then also professionally manage our exposure to private credit. And so before we discuss diversification, we first need to talk about risk management, because risk management is really the foundation of everything in private lending. And jump in the next slide, Corey. And so one of the major differences between private lending and traditional banking is how loans are evaluated and priced. So traditional banks operate within highly standardized underwriting boxes, right? Private lenders can often approach opportunities with more flexibility and common sense underwriting. At Mid-Atlantic specifically, we focus heavily on collateral quality, borrower experience, project viability, and repayment capacity. We also focus heavily on short-term lending structures. So shorter durations, reduces exposure to long-term market volatility and just changing economic conditions. Another key point is that our rates are generally higher than traditional banks. But again, that's often driven by speed, flexibility, service, and just execution certainty, not risk. So in fact, one of the reasons that private lenders can remain conservative is because of collateral positioning, and that leads directly into how we think about risk management. So we can go to the next slide, Corey. So if there's one section that investors should pay the closest attention to today, it's this one, because in private lending, risk management is everything. And at Mid-Atlantic, our approach to risk management really centers around three major principles. So the first is a time-tested model. The company has participated in over 700 transactions over the years with no investor losses. Now, importantly, that does not mean that there have never been challenges, right? Every lending business is going to encounter delays, market fluctuations, borrower issues, or just operational complexities. But what matters is how those risks are managed. Number two, second is due diligence. Our business is heavily relationship-based. A large percentage of our lending activity involves repeat borrowers and long-standing relationships. And so we spend a significant amount of time evaluating borrower experience, reputation, track record, financial strength, and project execution capability. And then third, collateral protection. So this is one of the core pillars of our underwriting philosophy. Typically, loans are structured well below the value of the underlying collateral. So that equity cushion is extremely important. So I'll give you an example. If a property is worth $1 million, our loan position may only represent roughly 60 to 70% of that value. That means there's going to be a substantial borrower equity beneath our position, and that alignment of incentive matters. And so one phrase I often like to use is this: risk management starts before the loan is ever made. So strong underwriting is what protects portfolios over time. And that underwriting process is heavily influenced by what lenders commonly refer to as the 4 C's of lending. Jump to the next slide. And so the 4 C's of lending are one of the foundational frameworks used throughout lending and underwriting. Those 4 C's are credit, collateral, and capacity. So credit, pretty self-explanatory, refers to the borrower's history and financial reliability. Collateral refers to the tangible asset securing the loan. Character is going to refer to the integrity, reputation, and trustworthiness of the borrower. And capacity refers to the borrower's ability to execute and repay. And so now one thing that's important in relationship-based private lending is that lending is not purely mathematical, right? Experience and judgment matter, character matters, reputation matters, execution history matters. And many experienced lenders are going to tell you that problems are often avoided long before a loan closes, simply by just being highly selective about who you choose to work with. And at Mid-Atlantic, we always want alignment. So we want to work with borrowers who, have experience, have capital invested themselves, have strong incentives to successfully complete projects. Because ultimately, successful lending is about creating mutually beneficial outcomes. And now with that underwriting framework in mind, let's just discuss some of the operational complexities that investors might not initially think about, when lending independently. Thanks for jumping ahead, Corey. Let me get water really quick. And so this is one of the most overlooked sections as well when investors first explore self-directed lending. So on the surface, direct lending sounds simple, right? But in practice, there can be many unattended operational and tax complexities. So for example, if an investor lends directly against collateral, for whatever reason the borrower defaults, there's potential for that lender to take ownership of that collateral. And that means suddenly that you may own a property, you may need to manage it, right? Sell it, improve it, or, gain profits from it or generate income from it. And inside of a self-directed IRA, that can, just create additional complexity. There are also important tax considerations, which Corey had hit on earlier, such as UBIT, which is unrelated business income tax. One of the advantages of using an intermediary or an asset manager structure is simplification, right? So the manager is going to handle servicing, legal processes, collections, operational management, and portfolio administration. And the investor continues earning interest distributions rather than managing collateral operations directly. So this is a very important concept. So many investors want exposure to private lending, but they don't necessarily want to become active lenders themselves. And that distinction matters. So now let's look at more specifically at everything an asset manager actually handles operationally behind the scenes. And so an asset manager is really your partner in lending services. So when people think about lending, they often think about just making the loan. But operationally, lending is an ongoing business process, right? So an asset manager or a loan servicer is going to handle sourcing borrowers, evaluating risk, collateral analysis, legal documentation, setting up the loans, servicing the loans, payment collections, compliance, tax reporting, and just ongoing portfolio administration. There's also, legal and compliance considerations as well. So loans must be documented correctly, secured correctly, recorded correctly, serviced correctly, and also monitored consistently. But that operational infrastructure is a major part of what investors are gaining access to through an experienced lending platform. Again, this goes back to one of the main, central themes of today's webinar, just simplification. So the investor is going to get exposure to private credit, real estate collateral, and income generation without needing to personally manage every operational component of the lending business. And so now we can shift into another major benefit many investors value, which is diversification through investment pooling. You could jump to the next slide, Corey. And so one of the biggest risks in direct investing is concentration risk. So if an investor puts a large amount of money into one property or one borrower or one project, then the success of that investment becomes heavily dependent on that single outcome. And so investment pooling really changes that dynamic. So through a diversified portfolio of receivables, investors are going to gain exposure across multiple borrowers and projects. And that diversification is going to help smooth out timing differences, delays, maybe project-specific issues, or just market fluctuations in general. And that's an extremely important concept for retirement-oriented investors, because for many investors, consistency is going to matter more than chasing maximum upside. Diversification can help create smoother income streams. You'll have better predictability. You reduce single project exposure. And so one phrase I often use is, the goal is not simply generating return, the goal is structuring consistency. And so diversification plays a major role in that. And so now with all of that context around risk management, diversification, let's finish by talking about why investors find this type of strategy appealing just from an income perspective. And so one of the reasons many investors are attracted to private credit strategies is the ability to create passive contractual income streams. And so at Mid-Atlantic, the structure is designed to provide flexibility for investors. And so that's going to include, investing inside or outside of an IRA, selecting terms, receiving automated distributions, and potentially accessing liquidity options as early as 90 days, depending on your structure and setup. Another important point is flexibility, right? Many investors can begin conservatively. They may start with a smaller allocation, become comfortable with the process, and increase exposure over time. And again, the overarching theme is simplicity, right? So the investor does not need to source the loans. They don't need to manage borrowers, oversee servicing, administer operations, or fix toilets, right? The structure is designed to create a more passive experience. And so before we move into Q&A, I just want to leave everybody with a few final thoughts. Get to the last slide, Corey. Thank you so much. First, thank you again to everybody for spending time with us today. I know there are a lot of investment options competing for people's attention, and hopefully today's discussion gave everybody a little stronger understanding of how private lending works, how risk management works, why many investors are incorporating private credit just into their broader retirement planning strategies. But the biggest takeaway I would leave everybody with is this, private credit, it's not about speculation. At its best, it's really about structure, discipline, collateral protection, and, consistency. And that's how I'd frame it. And for many investors, especially investors that are focused on income generation and capital preservation, those characteristics can be very valuable. If anybody would like to learn more, our website, explainer videos, and contact information are all available here. We're always happy to have educational conversations and answer questions and just help investors better understand the space. But with that, Corey, I'll turn it back over to you. We can move into questions. Thank you so much.
Awesome. Yeah. Thank you very much, Andrew. Appreciate the presentation and all the information you shared with our audience today. For the audience, as Andrew mentioned when he got started, we're going to kick over to Q&A now. So please feel free to add any questions into the Q&A box. I'll ask them to Andrew and we'll address them together for the remainder of the time we have here today. Andrew, I just have a few questions that I know I typically hear in these types of webinars, so I'll kick us off with a few myself to kind of warm up the audience. With this investment strategy, what, not without going into any specific offerings or anything that you have openly on the table right now, what is an investor looking at for like a minimum threshold and also a duration of hold for the dollars that they put into a specific investment?
Yeah, so
Just on average.
Our investment ranges are anywhere from 50,000 upwards of the $2 to $4 million range. So it gives a flexible entry point at 50,000. In terms of ranges or the fixed returns, our investors are seeing anywhere from 8 to 10%. Fixed income and contractual returns. Like I mentioned earlier, those are really focused in terms of how the portfolio is broken down, heavy focused on new construction, redevelopment, and then, sprinkling in transitional real estate opportunities as well.
And just another qualifying question for some of the audience here. Are these specifically available to accredited investors, non-accredited? Can you just speak on that briefly as well?
Yeah, of course. So we do have different lending entities that, our parent company, Credo Capital Management, does give access to, non-accredited investor opportunities as a start. But the current investment now is under Regulation D, Rule C, 506C. And so investors for the Mid-Atlantic Secured Income Fund must be accredited and verify their accreditation. But that's not to say that there are opportunities within our parent company that kind of open the door for investors that may not yet be accredited and kind of want to start that investment journey into debt fund or collateral-backed assets. So we do have options for both.
Awesome. And just for the audience here, as far as accreditation, when you're looking to invest with your retirement account, you'll typically get a accredited investor questionnaire from the sponsor of the deal. So when you get that, you fill it out as if the paperwork is for yourself personally, and it extends to your retirement account. So as long as you personally are accredited, your retirement account is thus allowed to make that investment, whatever it may be. So just wanted to put that piece of housekeeping out there. I do have a question from the audience. How do you calculate LTV?
Loan to value. So, we have a team, our underwriting team and our wholesale team that's kind of scouring the market specifically for the properties. And in terms of how they are calculating LTV, it's always from a conservative approach. So as I mentioned earlier, all of our loans in the portfolio are in that 60 to 70% loan to value ratio. And so they're looking at things about, they're kind of getting comps in the area. They're seeing, the project viability and also after repair values. And so that lets us, kind of be very clear on the loan to value percentage and, how we're assigning those. But if you're taking the portfolio in totality, our loan to value is in that 60 to 70% range consistently.
All right. Another quick question. Is it based on as is value of the asset prior to any work being done, or is it the after repair value?
Yeah, so it'd be after repair, just with the majority of the property, or the portfolio being new construction, but with some of the portfolio that is renovation or redevelopment, we are taking the ARV into account.
Okay. And God forbid this happens, but have you had any experiences with a borrower defaulting, and what is the kind of overall structure from the retirement account investor standpoint if that ends up occurring?
Well, yeah, I mean, because loans are collateral backed, the business is going to maintain legal rights against the collateral securing the loan. So the goal is always resolution and repayment first. However, if enforcement becomes necessary, the collateral position provides additional protection mechanisms. And so, most importantly, investors are diversified across a broader portfolio of receivables rather than tied to one individual property, borrower, or outcome. So,
And that's been, for the audience, at least something I've picked up on through Andrew's
yeah,
presentation is the diversification factor here. You're not specifically, while you're making one investment, you're not investing into one specific asset. It's a larger, more diverse and spread out play. So your money's not all tied to the success or potential failure of one specific, entity or asset. There's multiple that go into play here. So you're hedging a lot in this type of strategy. Would you kind of, I guess, expand on that, Andrew?
Yeah, of course. And I mean, you hit the nail on the head, Corey. Thanks for that. So the fund really focuses on private debt, real estate secured lending, right? So short-term lending that's tied to construction, renovation, redevelopment, bridge, and just related real estate opportunities. So the core idea is that the loans are supported by tangible collateral, all in first position structure, that are subject to terms of each investment and offering document. But again, to Corey's point, is that the investors are getting access to a broad portfolio of receivables. So now you're not tied to one borrower, one property, one outcome. You're reducing single project exposure risk, but you still have the upside of the fixed income, the debt obligations, and the interest that we're earning on the loans that we're giving to the borrowers.
Awesome. And I know some of our audience typically has this in mind. Can you just talk a little bit about what your geographic footprint is? Are you guys focusing on connecting with borrowers in a specific region or area? Or, I mean, have you done deals on the East Coast, West Coast, anywhere in the Midwest? Do you have any specific target capacity, or have you found a home or a niche in a specific area?
Yeah, so we definitely found a home in a niche. We're really focused in the Mid-Atlantic region, specifically Atlanta, Georgia. It's where we're headquartered. It's where our team is. Right now, I think we're very comfortable with investing in properties that we can see, feel, and touch, right? So when the communities you're investing in, when the upside of the area, you just have those connections. And a lot of, like I had mentioned earlier, a lot of it is relationship-based lending. So a lot of these relationships have been fostered, for decades now with some of our borrowers and the construction companies that we work with. But that's not to say that we're not open to expanding or, kind of vetting each opportunity as they come in, on an ad hoc basis. But right now, I think we've definitely found a niche that we're comfortable with, that's performing for our investors. And so right now it's really focused in the Mid-Atlantic region with a high focus in Atlanta.
The name certainly gives it away, but I always like to ask
Yeah.
that because sometimes we'll have an investor that maybe in like Iowa or something, and they're like, "Oh, I love everything I'm hearing, but I want to see something in my backyard where my dollars go
Yeah.
towards it." So it's always good to just ask, see what your expansion and growth might look like.
Yeah, we're always open to it, and the door is never shut. But I think it's just worked, and like I said, I think that plays a big role, is being able to touch, feel, and kind of see these projects firsthand has been huge for us. But I know the team has been open to expanding. So
And just a quick reminder to the audience, we've got about 10 to 12, maybe 15 minutes or so left. So please add any questions you've got for Andrew, take down his contact information here if you'd like to reach out one-to-one. We're not going to call you out by name, so please don't be shy with any questions you guys do want to ask. Here is one that just came in. This is a little bit lengthy, so just give me some patience as I read this out. What is your current loan default percentage? How many properties are currently in default? Can you discuss your current numbers of REOs and how they are handled? For example, how would you handle properties that are not completed? Do you source this out, or do you have the experience to do this in-house? Have you incurred losses on any REOs that were SOLC? Just to preface Andrew's response before he gives it. Because this is an educational platform and we have compliance from Advanta's end, he's not actually technically allowed to speak on any active open offerings or deals. So he may have a bit of a handicap in answering this question just based off of the clients that we have to, the compliance rather, that we have to put out on this platform for our side. So Andrew, that was a bit of a lengthy one there, but if you want to address that, or if you want me to read any portion of it back to you.
No, first, yeah, it's a great question. Transparency around credit quality and just asset management is important for us and important for the private credit, strategy in general. I'd be happy. I'm going to drop my email, my direct cell in the chat too, if anybody wants to, have just a more educational conversation. But our investors have access to a fund dashboard, and so they get, a real-time snapshot of the business. I had mentioned earlier, thankfully, we've had no investor losses since inception. I think that goes back to just our philosophy of emphasizing capital preservation through conservative loan structures, and all of our loans are senior secured positions. So even if there was, an outlier of a borrower default, it creates a windfall and a win for the business, because then we, take on that collateral, we can sell it for profit, improve it. And so the business has really been set up in a way to be advantageous and a win-win scenario. But I can kind of dive in more, to some of the specifics to that question if they want to shoot me a text or an email or jump on a quick call. And I could drop my info in the chat, Corey. That's helpful.
Yeah. And actually, the first aspect of what you provided in your answer there was going to be the next question I asked you. From a visibility standpoint, what would an investor receive or have access to once they fund one of these investments? You mentioned a portal, but let's just go into how often is that updated? If they had specific questions beyond what they're reviewing on the portal, do they have someone on your team in the investor relations that can hop on a phone call with them? What type of communication level would they expect?
Yeah, so our team is, always available, and I'll speak for myself, I always make myself available for investor calls. I think that's where we pride ourselves, is customer service. We know that, these allocations and the capital that's being deployed is meaningful to our investors. And so we take that very seriously. So we want to make sure that we're doing a lot of hand holding, we're guiding, giving confidence, but, providing full transparency. So like I had mentioned, in the onboarding process, you get access to an investor dashboard that's going to give you historical financial context and also a real-time snapshot of the business. So that's updated daily. You'll see how many lifetime projects we financed, how much money we've deployed in the lifetime of the company, how many consecutive months our investors have received distributions. You'll see data visualizations and pie charts of where our loans are deployed geographically. You'll see, revenue and consolidated profits quarter over quarter. I mean, you get all the bells and whistles with us. You get full transparency. We've had nothing but rave reviews in terms of when they have questions or want to know anything. It's all available for them. We're also giving them insight into actual projects. So you get to see, pictures of projects that we've worked on. What did they look like, in construction? What did they look like when they were finished, right? You're not kind of just left on an island and getting distributions, not knowing what we're working on. You're really part of it. And so, we pride ourselves in making our investors feel part of it, because they are, and their capital is meaningful, and it's moving the business forward, and it's improving communities. And so they get to see every step of that journey, as well as they get to see the state of the business and the growth of the business in real time.
And I'll attest to the level of communication as well. I mean, with my position at Advanta, I typically just deal with introductions to new investors and their onboarding process. And Andrew and his team are always really quick to respond and help. And as he mentioned, that hand-holding capacity to get someone that says they want to make an investment with their account set up and funding and everything turned around in a really quick, collaborative time frame and capacity. And then on the operations side, once the client has their account set up, getting the investment paperwork over to the client account management team, getting it approved and executing. It's always been very smooth and seamless with the Mid-Atlantic Group for sure.
Thank you, Corey. Likewise, Advanta is best. So we always appreciate working with you guys. Our investors that have been onboarded with you guys have nothing but things to say about the platform, about the customer service. So it's been great.
Thank you. Thank you. So you mentioned Credo Capital a few moments ago as your parent company. Can you expand just briefly on what they do, what type of oversight, if at all, or what their role is in relation to the Mid-Atlantic Group?
Yeah, so Credo Capital is the parent company, same business model, same structure. It's just the company kind of started out before it made the investments public to accredited investors. So that was more so started and built, but it wasn't publicly offered. And so when we finally launched Mid-Atlantic Secured Income Fund, it opened these types of investments and the portfolio to accredited investors, and it allowed us to do collaborations like we're doing today. So kind of just open the door for everybody to be involved in what we were already doing.
Understood. I see your contact information is there in the chat box. I will just give the audience another moment or two for any other questions to come in, and otherwise we'll probably wrap it up here in a minute. Andrew, I know you gave us a great presentation today, and I believe at 2 or 3 different points you mentioned key items that you want people to walk away with. Anything to expand or just reiterate with those key points and just takeaways that you hope everyone just really takes notes on or just remembers when they leave this presentation?
Yeah, no, I appreciate you kind of laying the floor for me there, Corey. Yeah, I think, just kind of going back to the central themes of today, right? Simplicity, consistency, and collateral protection. Me being an active investor and also just kind of navigating the current landscape, or even just, with family members, trying to guide them to finding solutions that, can protect their capital, but also help them generate meaningful income. It's nice to have exposure to private lending and private credit, because you get exposure to capital preservation, right, and real estate secured lending, but you don't necessarily have to be a lender yourself. So all of the operational and tax complexities, you avoid, everything simplified, but you still get that professional exposure, to this niche investment. And so I think it's a game changer for a lot of people, at least hearing from our investors, they wish they would have found us sooner. And how you mentioned kind of earlier in your segment, Corey, it's like, a ton of investors don't even know that they could do this type of investment, right? And then when they get set up through a self-directed IRA, it like opens up the floodgates, right? So I think people are sometimes very confined to what they're used to, whether that's the traditional, Wall Street casino or traditional 401k stocks. But once you're working through a self-directed IRA, you can really put your money into vehicles that can set you up long term. So that's probably what I would leave everybody with is self-directed IRAs are very powerful. Stay educated and stay in tune with investments that can provide both, right, consistency and collateral protection.
Awesome. And that's a really good way for me to pivot to our wrap up here. Everyone on today's presentation live, you will receive a recording of today's webinar within about the next day or so. And it'll also go onto our YouTube channel, which you can watch back at any time you want. Pause it, rewind it, fast forward. So hang tight, you'll get an email with that, or you could check the YouTube Advanta IRA page to check this out again. As I mentioned earlier, we've done multiple webinars with Andrew and his team. Nathan's been on with me a few times. So really thank you for participating with us again, Andrew, and I look forward to the next one we do in the future.
Yep, same. Thank you so much, Corey. Thank you, everybody, for joining today. Really appreciate it.
All right, everybody. Have a great day. We'll talk to you next time. Thank you.
Bye.